We are in a crypto winter. This is the fifth major drawdown of Bitcoin in the 5 years since I've been in the marketplace. This is a much milder winter than previous winters. It'll be shorter than previous winters. It's going to be followed by a spring and then a glorious summer. So don't fear. Bitcoin can fall to any level. It won't make much difference to us. One of the misconceptions people have is that that number really matters. The most important thing to understand is that we bought most of that Bitcoin with equity, not with debt. We will buy Bitcoin, if not every week, we'll definitely be buying Bitcoin every quarter going forward. We've got enough capital for the next 50 to 60 years. We can wait out any short-term downturn in the market. A week, a month, a year doesn't matter to us. We have $2.25 billion worth of just cash, and we have about 717,000 Bitcoin, which is equal to about 55 years worth of dividends.
Today, we have Bitcoin bull Michael Saylor discussing the crypto market, why the price of Bitcoin is being manipulated, and what his plan is for another crash in crypto in the days and weeks ahead. Saylor acknowledges that giant firms on Wall Street, as well as institutional investors with billions of dollars, are making big moves in crypto, based on fear and uncertainty. He believes that the agenda of some of these buyers may not exactly be what people think, and to prepare for a major market fluctuation very soon. Major players like BlackRock have added significant positions to their crypto portfolios, and as the world's largest asset manager, putting its $10 trillion weight behind it, has triggered Wall Street's fear of missing out. The Bitcoin price has fallen almost 28% in the past month, and with the Clarity Act pending, investors anticipate Trump's plan to reignite the economy. Let's get right into the latest interview with Michael Saylor, as he gives his prediction for the crypto crash and where Bitcoin is headed next. Don't forget to drop your comments down below, and leave a like if you enjoy the content we do here.
The market sentiment is negative, but you've now got an extraordinary risk-reward opportunity. Now is a much better time to invest. You know all the things that you wanted to happen have happened. If you're an investor, it really comes down to what your time horizon is and how much volatility can you stomach. Everybody's got different risk tolerance. They've all got different pools of capital. You know, over the last year, there's been 100 companies that have added Bitcoin to their balance sheet. The derivatives market and IBIT has surged. The flows into the ETFs have surged. All the major banks have announced support. I think that there'll be some skeptics. They don't really appreciate what Bitcoin is doing. They don't understand digital capital. They don't understand digital credit. You're getting the benefit of the crypto economy, but you're not on the volatility roller coaster. So
we've seen this pullback here over the past few weeks. I look at strategy stock down about 27% over the past month. Are investors losing faith in the Bitcoin movement?
If you don't want to trust anybody, you want no counterparty risk, you buy Bitcoin. Bitcoin's up 50% a year over 5 years. No counterparty risk. It's very straightforward. If you want to have your cake and eat it too, you could buy some convertible preferred like STRK. And if your time horizon is less than 4 years and you don't have much volatility to stomach, you shouldn't buy the equity or the equity hybrids. You should buy the credit, something like STRC. Everybody's got different risk tolerance. They've all got different pools of capital. The good news this year is now you've got a variety of different instruments you can use to ride the digital wave. All the major banks have announced support. The accounting has dramatically improved. The tax regime has improved. The administration support at the SEC, the CFTC, the Treasury level has improved. And so, and the technology has improved, you know. All the fundamentals are good. If you're going to be an equity investor, you have to think for yourself, and you have to have a time horizon of 4 years or longer. And equity markets are either going to lead or lag, and occasionally they'll perfectly reflect reality, but generally it's only a few days a year when they'll be perfectly rational. So if you don't have that 4-year time horizon, and if you don't want to make decisions based on fundamentals, if you simply want to park your money in a stable instrument and pick up a stable yield, you should be a credit investor. You shouldn't be an equity investor. I think the irony is is the fundamentals of the industry are so much better today than they were 12 months ago that you've now got an extraordinary risk reward opportunity. Now is a much better time to invest. But at the end of the day, the big dynamic in the industry is digital capital has gone from nothing to $2.5 trillion over 15 years. Digital credit didn't exist 12 months ago. We've issued nearly $8 billion of digital credit. Digital credit is got a tax equivalent yield of 4 times higher than bank credit. You know, you can have a bank account, you know, in New York City that pays you 4% and it's taxable, or you could buy something like STRC that pays you 10.5% that's tax deferred. So the market's evolving, and the short sellers aren't really interested in the impact of AI or the impact on digital assets to change the way the world works. They're just interested in being skeptical as a business. I don't really focus on them. Nothing great has ever been created by a short seller. I think the money market industry is massive. There's $30 trillion worth of assets invested in treasury-type instruments in the United States. Stretches about 1% of 1% of that industry. It's about a $3 billion issuance. And the big idea here is you take an asset appreciating 50% a year with a volatility in the mid-40s, and you strip the volatility from 45 down to below 5, maybe to 2, 3, or 4, or even 1, and then you extract about 10% dividend yield. And if you do that, you end up with something which is yielding 6% more than the risk-free rate. And when the vol gets to 1, you've got a Sharpe ratio of 6. So we're really engaging in financial engineering to distill pure currency yield above the risk-free rate. And of course, the common stock shareholders in MSTR get the difference between the 10% that we pay and the 50% that Bitcoin's been performing. Long term, the math is pretty simple. We expect Bitcoin to appreciate about 30% a year for the next 20 years. We expect to pay about 10% dividend yield on the preferreds. 2/3 of the benefit go to the common equity shareholders, and most of the volatility is stomached by the common equity shareholders and the corporation. And the credit investors get this pure 10% return of capital dividend. That means it's tax deferred. They don't have to pay tax on it until they sell the underlying instrument. And that means that they're able to invest in a credit instrument that pays them a 10% dividend instead of holding a money market that pays them 4% in a taxable coupon. You know, we joke there's no tariffs on Bitcoin. Bitcoin has no employees. It's got no corporate headquarters. It is an index reflecting the digital economy or the global digital economy. So if you just like to buy 1/21 millionth of the global free market, then you buy 1 Bitcoin.
Embracing an unyielding enthusiasm for the Bitcoin realm, Saylor and Lee confidently predict that explosive growth is looming on the horizon, as BlackRock and many other crypto giants are doing just that. Lee and Saylor reassure that a long-expected surge awaits. By the end of 2026, there will be 1.1 billion active crypto wallets. The pace of growth is hard to comprehend, and it will be the fastest accumulation of wealth we have ever seen. This is the conclusion of a career's worth of research. And every single chart and piece of research leads to the same conclusion. Liquidity drives everything, and crypto will be the best performing asset of them all.
The thing to keep in mind is that Bitcoin is outperforming the S&P by a factor of 2 to 3. And so if you can hold out through a 4-year cycle, then you can expect to outperform the S&P index. We have the option to simply hold the Bitcoin and return the Bitcoin or capital from the Bitcoin to our investors, or we can sell the equity that's backed by the Bitcoin in order to pay the dividend, or we can sell derivatives based upon our Bitcoin holdings in order to pay our dividends. Imagine you take a company public that holds a bunch of Manhattan real estate that you expect to go up 7% a year. Then you sell a preferred stock that pays a 3.5% dividend each year. you're just returning the first half of the capital appreciation of the real estate back to the credit investors in the form of a dividend. If you were holding the same amount in gold and you thought gold would go up 10% a year, you could pay a 5% dividend in a preferred stock. We are holding Bitcoin, which we expect to go up more than 20% a year. So we offer 11% dividend yield on the preferred stock backed by the Bitcoin that we hold. And so the credit investors are getting the first 11% return on Bitcoin in the form of a credit instrument. The equity investors are getting the return in excess of the 11%. So what we've done with STRC is created a digital credit instrument that can pay double-digit dividends, like 11%, in a return of capital dividend, so it's tax deferred. And then we over-collateralize that credit instrument with $4 to $5 worth of Bitcoin whenever we sell $1 of stretch. If the market seized up for the next 2.5 years, we just pay cash. That's why we have the 55 years worth of over-collateralization in the Bitcoin. So you're right. If you needed to be perfect in the next week or the next month, there might be risk. We just need to be right over the next decade for the equity to pay off. And we need to be right, sometime in the next 40 or 50 years in order for the credit to be workable. Bitcoin is global digital capital. It's above my pay grade to speculate about where the interest rates will go. But what I'll say is there are three primary drivers of the Bitcoin price that are all bullish. There are those that believe that Bitcoin is a better gold than gold because it's scarce and it's teleportable. And so people that believe in a debasement trade or they want a non-sovereign store of value will buy Bitcoin for the long term for that reason. There are other people that believe in the digital transformation of finance, and they think of Bitcoin as amplified big tech. And then there's a third set of people that want global property, and they simply want the highest, best property in the world that they can move to any country anytime they want. And so Bitcoin's driven by all three of those dynamics, sometimes on different days of the week. And so it defies putting into a simple bucket, but it's going to win for one of those three reasons, regardless of what the macro environment works out to be.
It truly is interesting now that I hear more than a few people saying that to diversify their portfolios, and they're not necessarily Bitcoin believers.
If we did buy the Bitcoin at a little bit higher than the current level, we sold equity that it was a massive premium to the Bitcoin at the time that we bought it. So if we had borrowed money to buy the Bitcoin, it might be an issue. But we were the largest issuer of equity in 2024 in the entire capital market. We were the largest issuer of equity in 2025 in the entire capital market. I think the company raised $55 billion of capital, but only 8 of the $55 billion was debt. We're like the company that owns 3.4% of Manhattan with enough capital to hold out to the end of the century. And you're telling me that it's been a bad week or a bad month in Manhattan real estate market. We believe in the future of the network, and we built the balance sheet accordingly.
In this context, Bitcoin emerges as an alternative, detached from the manipulations of the conventional economic sphere. Saylor also highlights that established corporations like Apple, Amazon, and Google will use their established relationships acquired over decades to swiftly acquire substantial amounts of Bitcoin through a spot ETF, bypassing the cumbersome processes involved in procuring the actual commodity. This disparity underscores the transformative power of cryptocurrencies in traditional financial institutions. Michael Saylor underscores the importance of embracing digital currencies as the economic landscape is changing rapidly, and urges investors to leverage Bitcoin's potential to secure a more prosperous financial future. What do you think about the latest interview with Michael Saylor? And how do you think Bitcoin's trajectory in the coming months will impact the crypto market and the world of investing? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this.